In the US, 3 banks have failed in 5 days. In fact, Silicon Valley Bank and Signature Bank were the second and third largest bank failures in US history, smaller only than the 2008 collapse of Washington Mutual. And even though the Fed was taking extraordinary emergency measures to mitigate fallout across the banking sector and was successfully able to calm the situation and ease concerns about a broader bank run, the stocks of respected financial institutions like Charles Schwab and the stocks of smaller regional banks experienced an outright meltdown, with the S&P Regional Banking ETF dropping by more than 12% on Monday morning, and individual stocks like the San Francisco-based bank First Republic ending the day down more than 60%. Now, President Biden even released a statement to reaffirm confidence in the banking sector. And as I just said, government officials working through the weekend were able to prevent a broader bank run on Monday morning. Okay, and that's just to provide some context for this video. On Twitter, there were several hundreds or thousands of threads on the SVB situation over the last few days, more than any human can possibly read. But one long tweet by Bill Ackman stood out to me, and I want to break down what exactly he said and warned about, namely that going forward, bank runs have just become much more likely. Okay, so on Monday, famous hedge fund manager Bill Ackman posted this long tweet here on Twitter. He starts by stating that recent events have made clear in the mind of the average American that there is a risk that they could lose money doing something they used to think of as safe, being a depositor. And what Ackman describes here is that the average American person may now have understood that bank runs actually exist, and that depending on where they put their money, it may not be as safe as they previously thought. But let's go one step back. What is actually a bank run? Well, the whole business model of banks is to invest most of the money deposited with them in loans or bonds instead of just safekeeping the full amounts, passing on part of the interest earned from those investments to the customer and keeping the rest as a service fee. Now, there can be situations where a large number of customers of a bank all of a sudden withdraw their deposits in a short period of time, causing a severe liquidity crisis for the bank. The most likely reason for this is customers losing confidence in the bank's ability to meet its financial obligations. And these concerns may be completely rational, as the bank may in fact be poorly capitalized, but bank runs can also occur based on rumors or news of the financial instability or insolvency of a certain bank. In 1973, for instance, a bank run occurred at the Japanese Toyokawa Shinkin Bank, solely based on a spontaneous rumor that originated from a conversation between 3 high school students. During a bank run, the bank may not have enough cash or liquid assets on hand to meet the withdrawal demands of its customers, and it may be forced to sell assets or borrow money to cover the withdrawals. This is part of the reason why SVB failed, and other banks are at risk as well, because they collectively have hundreds of billions in unrealized losses on bonds that they bought at peak prices in 2020 and 2021 at low interest rates that now, after the steepest interest rate hike cycle in US history, are worth much less. But I want to get back to Ackman's tweet here. I just said that psychology plays an important role in bank runs, as the behavior and emotions of bank customers can drive this phenomenon. In particular, bank runs can be triggered by fear, panic, and a loss of confidence in the banking system or the solvency of a particular bank. Ackman points out that during the age of social media, bank runs are probably much more likely. To quote him here, "In a world with Twitter, speed spread of information, and smartphone-enabled bank accounts, where withdrawals can be made with a push of a button, no bank is safe from a run." Now, what I found particularly disturbing during the last few days is that there were Twitter users that actually tried to spread fear regarding a bank run, posting panic-inducing tweets or videos of lines in front of various bank branches. And some of these users might actually be trying to manipulate the market by trying to instill fear and start a bank run, and at the same time being short bank stocks. For example, I came across this thread on Reddit that shows how one particular Twitter user may follow a very suspicious incentive. I'll leave a link to the thread in the description box down below so you can decide for yourself what you think of it. But the tweet that I retweeted of this guy is actually deleted by now, so I'm really not sure what to think of it, but I think it's fairly suspicious. Okay, to get back to Ackman's point, the digital age and the widespread use of smartphones have arguably made bank runs much more likely to happen. And I think there are 3 reasons for this. First, increased access to information. Smartphones and the internet have made it easier for customers to access information about their bank's financial stability and financial health. And news and rumors of a bank's financial instability can of course spread much more rapidly through social media and online news platforms, causing panic and potentially triggering a bank run. Secondly, what Ackman also pointed out is that with mobile banking apps, money transactions have become a lot easier and frictionless. Smartphones have made it easier for customers to make withdrawals and transfers, which can of course facilitate a bank run, as customers don't have to stand in lines and wait and physically visit a bank branch. I saw this great video shared by Ben Carlson on Twitter about the tactics a bank owner used to prevent a bank run many decades ago. He told his employees to simply smile, be polite, and take their time when processing withdrawal requests, by counting the money twice, paying out small bills instead of $100 bills, etc. Let me just show you a short sequence from that video.
Visitors began to clamor to withdraw all their money. One of George Eccles' jobs was to brief his cashiers on how to handle the run.
Well, then we called all our employees together, and we told them to be at the bank at their place at 8 o'clock, and just to act as if nothing was happening, just have a smile on their face, if they could, and me too. And we said, never leave the window. Lunch hour, anything else, we must have every window open all day. But the important thing was, we knew you'd have a big line there, so there's no use trying to hurry because the line was going to continue. So we said, now, when you get a withdrawal slip and the passbook, go back and check the signature, even though you know your friend John Jones, just to delay time, just to mark time. And then when you pay the money out, we're not going to pay in $100 bills. We're going to pay in 5, 10s, and 20s. And count it twice and hand it out with a smile.
And finally, as we just said, the constant connectivity provided by smartphones means that news of financial instability or rumors about a bank's health and solvency can spread quickly and widely. This can create anxiety and fear among bank customers, leading to a heightened risk of a bank run. Now, overall, I think I'm in no position to assess whether bank runs are necessarily more likely in the digital age. But I think those are some very valid points that can explain why the speed and scale at which bank runs can occur may have increased in recent years. Bill Ackman writes, consumers now understand that when a bank stock collapses, it is only a matter of days before the bank fails due to liquidity demands by their depositors. And all of this makes it important for regulators and policymakers to understand and address these new risks. And this is what Bill Ackman also discusses in his tweet. He wrote, "We have had a two-tiered system since the great financial crisis, where a few large banks have the explicit backing of the taxpayer and the rest have $250,000 of deposit insurance. This two-tiered system worked until it didn't work. Until this problem is solved, our banking system is at risk." He demands that depositors get an, quote-unquote, explicit government guarantee that ensures that they, so depositors, always have complete access to the total value of their deposits. Without this guarantee, the non-systemically important banks will likely continue to experience large withdrawals. Alright, let me know what you think about the current environment and situation in the comments down below. Take care.